Hey, everybody. Welcome back to the Blockware Intelligence Podcast. Hope you're all doing well. Before we get into the show, let me tell you a little bit about our sponsor, FTX US. FTX US, one of the largest crypto companies in the United States, is the safest, most regulated way to buy and sell Bitcoin, Ethereum, and other digital assets. You might have heard of FTX from their partnerships with Tom Brady, Steph Curry, or their recent Super Bowl commercial with Larry David. With FTX, you can trade crypto with up to 85% lower fees than top competitors. There are no fixed minimum fees, no ACH transaction fees, and no withdrawal fees. You can also use the FTX app to buy your favorite NFTs with no gas fees, supporting both Ethereum and Solana blockchains. Use promo code Blockware1 or go to ftx.blockwareintelligence.com to earn free crypto on every trade over $10. Again, that's Blockware1 on ftx.us or go to ftx.blockwareintelligence.com to get started today. Now let's get into the show. Hey, everybody. Welcome back to the Blockware Intelligence Podcast. Today we have a very special guest, someone I've been looking forward to talk to for a long time, Lyn Alden. Lyn, thanks so much for taking the time. I know you're in very high demand these days, so we appreciate you coming on the Blockware Intelligence Podcast.
Happy to be here.
First of all, I want to start with some, I guess current events and, obviously the last few days in crypto, the kind of the talk of the town has been the Luna Foundation guard, and the UST peg breaking down. For listeners, maybe anybody who hasn't heard about this, or maybe anyone who just doesn't really understand the dynamics of everything that's happened over the last call it 72 hours. You kind of walk us through what happened and what caused that meltdown, and as well as like how does the Terra protocol work?
Yeah, so the Terra ecosystem is basically based around algorithmic stablecoins, and those are very different from collateralized stablecoins. And so for collateralized stablecoins like Tether or USDC, they hold a certain amount of assets that can be redeemed, for those tokens. Basically, you're at least supposedly backed one-to-one by assets. Whereas in an algorithmic stablecoin, they use software to try to make a token worth $1, even though it's not actually backed up by any dollars, right? It's just kind of this artificial mechanism to try to maintain it at the value of $1. And as one might expect, those have been fraught with failure. You're kind of the mechanism is you're trying to be like an emerging market central bank, except without capital controls and without an economy to tax. It's kind of like this based on this first in, first out, and a really shaky set of kind of economic principles that can only last so long. And so the way that worked is if their stablecoin was below the peg, it was below $1, you could basically arbitrage that in order to get that back up using their other token, which is Luna. And so basically what it does is it pushes the volatility over to Luna. And as long as their stablecoin demand is increasing, it also increases the value of Luna over time generally. But the problem is that the demand for that was artificial. It was based on artificially high yields from various VC incentives and things like that. Basically, it wasn't a sustainable organic demand. It was kind of this, you can call it a Ponzi scheme. That's not really far off. Basically, it's this kind of front-loaded, unsustainable type of thing to draw capital in, and those are vulnerable to attack. Even without an attack, basically UST surplus yields were going to dry up, and so basically we saw a run on the bank. Basically people started to see that it was failing, and they all wanted out at the same time, and so Luna's equity was brought down to basically zero. You lose 99% plus of the value, it goes to zero, and the peg breaks. And so this was something like, if you combine Luna and their stable coins, it was nearly a $60 billion protocol, and that was wiped out in a matter of days. And a challenge is that I think they saw the writing on the wall. They were worried about the possibility of a death spiral, so they started buying other assets ahead of time, kind of like an emerging market, holding treasuries or gold as a reserve currency that they can sell if they want to support their currency. And so they bought Bitcoin, and then they had to sell that into the market, or specifically they were loading it to market makers to do various ways to try to defend the peg. And so they had to sell Bitcoin into a weak market. And now there's contagion because multiple funds had exposure to it. This was kind of like a Lehman Brothers moment for the crypto space. And if we zoom out for a while. So there are a number of people warning about this. I warned about it in the month ahead. And if we zoom out of why this happens over time, right? If you look at business cycles, right? So, and I've shared this with you before, that the PMI cycle, so Purchasing Managers Index, you know, that's kind of a gauge of is economic growth accelerating or is it beginning to slow down? And it's not whether it's growing or shrinking, it's whether it's accelerating or decelerating. Although if the number gets low enough, it becomes outright shrinking. And what you generally see is that during accelerating periods, that's when liquidity is flowing. It's easy to get credit. Often the Federal Reserve is pumping money into the market. You have these economic booms in the United States and many other parts of the world, and anyone with like a narrative can sell these tokens, these unregistered securities and offshore regulatory gray zones, right? They can just pull in capital, and when you have those declining PMI environments, liquidity being withdrawn, it's like the tide going out, and anyone who's swimming naked gets exposed, or at least a lot of them. And we generally see these boom bust cycles. And so that's essentially what we're seeing now, is that after a big giant rise up in PMIs and economic growth and liquidity, we're now getting a pullback in all those things. And so all these things that were kind of based on first in, first out, Ponzi-nomics, the vast majority of that is just getting cleared away. And unfortunately, that's a very large percentage of the crypto space.
Yeah, for sure. Do you think this attack was nefarious in the sense of, someone purposely tried to take down the peg, or, do you think it was something where it's just low hanging fruit and someone was going to do it if someone else didn't step in and do it? There's been this conspiracy theory circulating about Citadel and BlackRock, and they both come out and denied that they had any involvement. But do you think this was, perhaps an entity or group of large entities in the crypto space that saw an opportunity? Or do you think this was just, it just happened because of kind of the backdrop of weak price action, weak macro environment, everything you just described, and it was just kind of inevitably going to happen at some point?
So I think if something can be attacked, it will be attacked, right? If you can make money from attacking it, it will be. And that's the problem with algorithmic stablecoins. Essentially, their whole defense playbook is public. So, if there's a military and you know exactly how they're going to respond, you would know exactly how to attack. And, attacking this peg in a bull market would be a lot harder, right? Because confidence in it would be high. Whereas attacking it in this kind of, low liquidity, tide going out environment, that's basically when they have openings that you can do an attack. And so, evidence does suggest it was a well capitalized intentional attack. I don't know for sure who did it, obviously, but I think in the long run this was inevitable. I think if this didn't happen now, so for example, when I was warning about this potentially happening, I didn't expect it was going to happen, in mid-May, right? That wasn't, it was actually earlier than I would have guessed, because you can't predict when an attack like that's going to happen. It was more like, if you're predicting a forest fire, you can't say when lightning is going to strike a tree and start a forest fire, but you can warn when there's conditions that would make a forest fire likely or risky to happen. And that's essentially the state they were in. Basically, it was a very risky situation. Over the long run, if there was no specific attack, I think what would have happened is that demand for UST, their stable coin, would have dried up as the yields dried up in Anchor, and eventually, I think you would have gotten a slower bank run until it turned out into a crisis like this. So instead, we kind of ripped the bandit off, got it out ahead of time. And so, I think it was inevitable one way or another.
Yeah, no, I agree with you. And kind of going off of that, obviously, like they've had to sell off all of their Bitcoin reserves, and it's been wild. I posted the chart yesterday of like, it just shows like their wallet holdings, and it's wild. It's just like, stairs up, elevator straight down. But aside from just like the shorter term price impact on BTC, which I think it's caused like some short term drawdown in price, but BTC can absorb this, right? It's the most liquid asset in this crypto ecosystem. But what I think is yet to be seen is some of like the contagion from this event. I mean, obviously you described like this is a multi-billion dollar, or was a multi-billion dollar protocol. And, there's probably numerous funds and projects alike that have heavy exposure to both Luna and UST. So, how do you think through that? And do you think we'll see more second order, third order effects coming out of this that will emerge in the crypto space over the coming days or weeks?
I think so. I think basically we saw the kill shot, and now the industry's got to bleed out a lot of the malinvestment. And that already happened pretty quickly. But I think, if you look through bear markets, generally you start to see Bitcoin dominance rise, especially say Bitcoin X stablecoin dominance. So put the collateralized stablecoins aside, Bitcoin compared to all the other cryptos. I think basically we had over $1 trillion of malinvestment in the space, and that's basically going to get sorted out, or at least a lot of it's going to get sorted out in the coming days, weeks, and months. Um, and basically it's natural that now everything's being tested, right? So something blew up, everything's being tested. They're testing the tether peg, they're testing this, they're testing that. We're going to see which funds didn't make it through, and when there's kind of industry-wide liquidity being withdrawn, Bitcoin can hold up among the best because it's liquid and because it's not having any sort of technical issues like many of these other things are. But even that gets pulled down in price because if you're outside capital, if you're not in the crypto space and you're thinking about investing in Bitcoin, this is not the moment where a lot of outside funds are going to be like, you know what, we should buy Bitcoin. Now maybe there'll be really forward-thinking ones that say, hey, look, it's all on sale. We've been waiting to get in. This is the time. But basically, the kind of the normie finance is sitting there just kind of watching this play out, and everybody's kind of risking off. And so I think it has to just there's more contagion likely to happen. Although we might have seen the bottom in Bitcoin. I have no idea. My base case is that Bitcoin will go on to make new all-time highs eventually, and I think a lot of crypto projects won't. I think they have one or two cycles in them, and then they've played out their story, and then it's on to whatever the next narrative is.
Yeah, for sure. And like you had kind of touched on the potential, I guess delay in some investment from people after like, this big event that is probably causing, some hesitancy to get involved in the space. Do you think also with regulators, you'll continue to just see the drum get beat now? I mean, like the Elizabeth Warrens of the world have to be like salivating over this event from a political standpoint. I mean, I saw this morning that Janet Yellen had come out and made some comments about the risks of stable coins, obviously talking about UST, but also had mentioned about this slight depeg that we saw in USDT, although that's happened numerous times throughout the years that it's existed. But I guess how do you think through the effects on what regulators are going to be doing based off of this event over the coming months and years?
I do think this will accelerate regulation because a lot of retail investors got hurt. I mean, they were told by people on YouTube to buy Luna and things like that. You even had a lot of content creators that themselves were like, they revealed they were 100% Luna, which is, they kind of like ate too much of their own cooking. And VCs are hurt, but then also VCs were selling these things to the public, marketing these to the public. So I think, regulators are going to go after some of the major exchanges. They do things like whenever there's like a spike in enthusiasm for a token, they fuel it. They start advertising for dog money or whatever the token of the day is. They kind of funnel retail into it right at the top. And a lot of these pass the Howey test, so they look like securities. They could be regulated as such. Outside of Bitcoin, it doesn't pass the Howey test. Maybe a few others, right? There's a number of them that don't really pass it, but a lot of them do. And they kind of been in this gray zone where they don't do their initial coin offerings in the United States anymore, but the exchange is still marketed them once they're already sold to U.S. buyers. And so I think that that practice could get more scrutiny. And even I think a lot of people don't know the difference between different stable coins, right? So they see one stable coin blow up, an algorithmic stable coin, and then they use that to criticize the collateralized ones. But I also think over time we're going to see more regulation on what you can use as collateral for a collateralized stablecoin. And one way I would describe that is, if you look at so there's kind of two models you can go with. One is if you have as many assets as you have liabilities, so you're 1-to-1, then you better have all of your assets in risk-free investments because there's no margin of error there. If you lose any percentage of your investments, you're now no longer fully backed. So if you're roughly 1-to-1 backed, and you're supposed to be dollars, you should have the whole fund in dollars and T-bills, basically liquid dollar-based assets. Um, Now, the other option is to go like with a bank model. So banks, their assets are a variety of different risks. So they have things like cash and treasuries, but they also have things like loans and corporate bonds and things like that. But because of that risk, they have to have a capital buffer. They have to have more assets than they have liabilities so that even if they lose some of their assets, they can still meet their liabilities. And some stable coins have operated in that weird zone where they're one-to-one backed, or that at least that's what the accounting firms say, they're one-to-one backed, but then they're not 100% backed in risk-free capital, and so that kind of creates systemic risk. And we've seen over time stable coins have kind of shifted towards having a greater percentage of their assets in cash and T-bills, and many of them have gone 100% cash and T-bills. And I think that's kind of the trend where regulators are going to look unfavorably towards stable coins that have any degree of risk in their asset books.
It seems like, with all the regulation coming about into the DeFi space, it's almost like a mirrored version of the current system in that sense of how centralized everything is and how much regulation is coming into the space. Do you think there's a possibility for DeFi to just become a completely mirrored version of, or, basically throwing lipstick on a pig of the current fiat system that we already have? I guess, like, how do you kind of, look at the DeFi system as a whole, but moving forward, kind of the evolution of it in terms of how decentralized it could be, and do you think it will even exist in like 5 or 10 years from now? I think there's a lot of interesting stuff going on, but it's just a question of, like, is it actually going to be decentralized, and is it just going to end up as a, basically a new version of the same thing we already have going, if that makes sense?
So Chain Analysis did some analysis a while back and showed that the vast majority of DeFi volume is like institutional and large whales, right? So it's kind of a mirror of the existing system almost. And I don't view any of it as kind of being over the event horizon in terms of how decentralized it is. Uh, to some extent, decentralization is a spectrum, but at the end of the day, if regulators really go after you, you're either decentralized and can withstand a regulatory attack, or you can't. And I think the vast majority of it is not over that critical threshold, and so they're all prone to being regulated, which kind of puts them in the same sort of situation, uh, as we see with the existing system. And so I do think that there's interesting code being developed. There's interesting use cases out there. I think decentralized liquidity is useful. Decentralized exchanges are useful. I think a problem is that it like when they started inventing the car, for example, they would put like reins on it because people just kind of had this old way of thinking, right? And it's like you want to you want to have like aspects of the prior system, like horses, in your new system. Just you don't like change everything at once. And I think a lot of the concept we're seeing now around like leveraging hypothecation, yields that are not really yields, a lot of that is kind of like reins on a car. It's like an old way of thinking about it. And I think that the way I keep coming back to, I think Bitcoin's innovation. Most other things are kind of like fleas riding on its coattails. I do think collateralized stablecoins are an innovation. They basically took some of that technology, and so for example, if you are in Lebanon or Argentina, things like USDC or USDT can actually be perceived as being safer than storing dollars in your bank or your local currency, because in those countries, obviously holding local currency is very risky, and if they hold dollars in the bank, they get confiscated. That's happened a number of times in a lot of these countries, and so ironically, holding this dollar pegged asset from a foreign entity is in many cases rightly perceived as safer, and it has less volatility than Bitcoin for people that you can't have volatility over a 3 to 6 month period for their income and their short-term savings and their spending. And so outside of Bitcoin and well collateralized stable coins, I think a lot of what we're seeing elsewhere is malinvestment, even though I think some of it eventually can make its way onto future platforms.
For sure. I want to pivot over to price action, and I made a post on Twitter, and I said, "What do you want me to ask Lyn?" And I would say 30 to 40% of the questions were just when bottom. So I'm not going to ask you that, but I will ask you, what are some of the areas, either from just a pure price action standpoint, maybe it's moving averages or on-chain price levels, like what are some of the areas that you find really attractive and would say are deep value for BTC as we kind of move into the mid to upper 20K areas?
I think this mid 20 area is super deep value, right? So when you look at things like dormancy flow, or like just a bunch of different on-chain indicators are kind of deep value. Now, at the end of the day, you can have these wicks that go well below that if there's kind of like liquidity crises. But overall, I think we're kind of in that range where I don't know exactly where the bottom is going to be. Obviously, I think you're in the phase where if you're dollar cost averaging or you're layering in purchases, I think this is a good place to do it. I think trying to catch some sort of like micro bottom is kind of a fool's game. Uh, some things I'm watching, for example, I was watching the tether peg because it's kind of a sign of liquidity, right? If that peg is struggling, in addition to whatever concerns people might have about the quality of the collateral, it's a liquidity sign, right? So liquidity is being sucked out of the space so fast, so it's hard for anything to rally. And when you start to see that kind of recover to the extent that it recovers, that's kind of a sign that maybe the worst is behind us, and some projects will continue to bleed out, but maybe the highest quality things like Bitcoin, they might already have their capitulation in. And so it's hard to say for sure, but I think that anywhere in with a two handle, you're basically getting into kind of deep value range, and then it just comes down to managing your own risk bucket, right? So a lot of people think they can withstand volatility, and then when it actually happens, they realize they can't. And so I think it's important to have the position size that makes sense to you, so that you can have, unless you're an active trader, so that you can have a 3 to 5 year, position and let that play out, according to your thesis or not.
Yeah, it's funny. I'm in some of these different like trading groups, if you will, different like crypto native trading guys, and they were saying last night, well, the one thing you want to look for is when spreads blow out and the exchanges start breaking. That's usually a time of at least a local bottom. So yeah, it's been interesting. You started to see some of that. I'm still looking for some stuff like the 3-month basis to go into backwardation. Coinbase going down. Those are usually some like low hanging fruit signals that we're reaching at least a local bottom. But no, I completely agree with you. I think like this low to mid 20K area is extreme value for BTC. I mean, you've got realized price at 24K, 200-week moving average, I believe, at like 22, 23K. So, I mean, it's a question of, in 5 years, will it make a difference if you bought at 26K or 25K versus, exactly at the 200-week at 22K? I tend to not think so, and I agree. I think this is like a good time to dollar cost average more heavily than perhaps maybe you traditionally have. I want to move on a little bit to your thoughts on on-chain analytics. So you and I have talked a little bit in DMs about this, and we kind of go back and forth with ideas. How do you think through on-chain? I think it's been interesting because this has been the first like real bull cycle for BTC. I guess you could say full cycle now that we're back in a bear market. For on-chain to really be used in a real-time basis with the full slew of metrics that were created in the 2018 2019 bear market. So how do you think through on-chain, the evolution of it, and I guess how do you implement it into the weighing of your analysis for the Bitcoin market?
So with any market, you kind of want to know who the buyers and the sellers are to the extent that it's possible, right? And so with Bitcoin, because we have that on-chain analysis, I'm not talking about identities, but talking about kind of like, the different types of buyers and what they're doing, right? So what are short-term holders doing? What are long-term holders doing? What are futures market people doing? So that's separate from on-chain. But I think, combining on-chain with, any sort of exchange data that's possible or any sort of futures data that's possible, kind of gives you a holistic view of what's going on in the market. And I don't really use it as forecasting, but I use it as, kind of like market awareness. A lot of people, when they get into Bitcoin, they just see a line on a chart. They don't know how the technical details work. And by technical, I mean, I'm talking about the actual functioning of the blockchain. They don't know how that works super well. And then they don't understand who the different buyers and sellers are. And so for them, it's like a scary black box that they don't want to put any capital in. And I think that things like, you know, various types of analysis like on chain and things like that can provide a little bit more clarity and help people understand what happens with these cycles, right? So I like, for example, seeing the percentage of coins that have not moved for a long period of time. What's happening with accumulation addresses versus other types of addresses, because you can see in these long-term consolidations, you have weak money flows back into the stronger money hands, right? And that's something that a lot of people from other markets can relate to. They understand that dynamic, that psychology there, and so I think it's a good observational tool. So I do, for example, in my various macro reports, I'll when I have a Bitcoin section, I'll touch on some of the unique things that are happening in on-chain space and some other things like that, even though I'm not, say, making buy or sell recommendations based on what I'm seeing in any sort of specific on-chain metric.
Yeah, no, that makes a lot of sense. I do think also, as you mentioned, like it definitely needs to be paired with other things. You can't look at solely on chain to come to your conclusion about the market, especially as it just becomes more nuanced and more complex. I think you could have used it back in, 2014, 2015, 2016 when it was just a completely spot driven market. But now there's so many different dynamics affecting price action that, I think you're walking blindly if you're just looking at solely on chain. And it's interesting you phrased it that way, that you don't look at it, for like shorter term price predictions, but rather kind of get this broader gauge as to what's going on. One thing you talked about, for example, like dormancy flow, some of these like broader oscillators. I think one way to look at on chain is, for these people that are kind of swinging the cycles, perhaps from these, major points of exuberance, major points of depression. You can look at 6, 7, 8 of these broader oscillators and look and say, hey, look, when 80% of these are in the upper 10 percentile or lower 10 percentile, I'm going to start shaving off. Or I'm going to start averaging in more heavily. Even using it in that sense, I think is really beneficial. But it's interesting to get your thoughts on that. What else do you think about just your Bitcoin market view? What things do you look at? Obviously, macro has been in the driver's seat for months now, so I'm sure that's a very large portion of this. But what different types of indicators are you looking at, or I guess different forms of analysis? If you had a tool belt, I would say what different tools are in that belt?
So aside from the Bitcoin specific ones like on chain, I would say the biggest ones are the macro ones because Bitcoin is now big enough to be a macro asset. And even before it was still a liquidity play essentially, in terms of when new capital flows in and flows out, right? So different than the people who hardcore understand the underlying technology. In terms of price action, it was always a liquidity play, and now it's increasingly also a macro play, which is it's kind of the same thing but bigger. And so that I would say, so going back to the PMI cycle that I mentioned before, right? So the world and let's say specifically the United States, as a really big Bitcoin market, and crypto market in general, goes through these PMI cycles. These it's almost like the heartbeat of economic growth acceleration and economic growth deceleration. And they vary a little bit, but they're on average about 3 years. So it looks like a sine wave, and each like full cycles maybe 3 years. So you have like 18 months of going up and then 18 months of going down. And most, basically Bitcoin bull runs have happened during rising PMI environments, and Bitcoin consolidations and bear markets have happened during declining PMI environments. And it's not perfect. It's not like it bottoms right when the PMI bottoms. In fact, the market's forward looking, so it bottoms before PMI bottoms. But you generally get that kind of big risk on, risk off framework. Same thing with liquidity. If you look at what's happening with the global liquidity, it kind of looks like the PMI cycle. And so, you can kind of apply that. And, what people do with that is I think, depends on what kind of investor they are. If they're just dollar cost averaging in, they might completely ignore it. But if they're, when I'm speaking to institutional allocators or things like that, if you're looking for when to take more risk or when to take less risk, if Bitcoin has been blown out and the PMI cycle is already rolled over, that's a good contrarian time to maybe accelerate your purchases to some extent. And when you're at the top of a PMI cycle and people are super enthusiastic and liquidity is flowing and Dogecoin's going vertical, that's when there's a lot more risk in the market. And maybe if they're doing leverage, they should pare the leverage back. Maybe they can make changes to the way that they might want to rebalance depending on what type of pools of capital they are. And so I use that as kind of my primary outlook. And so what we're seeing now is that PMI is still declining. We're at kind of a part of the cycle where maybe Bitcoin could bottom here. Like if you look at the prior cycle, this is kind of where what PMI was looking like when it already bottomed. But every cycle is going to be different. So people trying to over match the prior cycle to the current cycle, I think is missing the point of it. It's really just kind of this broad general idea of risk on versus risk off. Um, and another thing is a lot of attention's on the halving cycle, and I do think that the halving cycle is important. So obviously, if you cut new supply in half, that's going to affect the market over time. But so the halving cycles every 4 years, the PMI cycles every 3 years, and pretty much because of luck, those have generally somewhat aligned. Obviously, you have a slight phase shift because one is a slightly longer cycle than the other, but they've generally aligned. In the past few cycles, and it slowly gets out of phase over time. And so it's harder to say, basically you had kind of a perfect storm each time. So you had rising PMI and a halving, and that creates a very strong risk on condition. And after the PMI rolls over, that's when you get that risk off condition. And so I think a lot of people are maybe still focused on halving cycles. I think they should probably become a little less important over time. And it's, focusing on the PMI cycles, I think can be very useful. And that's, it doesn't mean that it can be a good thing because you don't get locked into this 4-year cycle framework, right? So we've seen lengthening cycles. We've seen, maybe it hit lower highs than people thought, including myself. But when you look at the PMI cycle, a lot of that makes more sense. Basically, when you realize it's not entirely driven by the halving cycle, there's other liquidity and macro forces at play that can determine, you know, when Bitcoin ramps up and when it ramps down. When what's happening with global capital around the world. So I think looking at PMI is probably a pretty important thing for people to be aware of.
That actually segues pretty nicely into the next thing I wanted to talk to you about, which is this really heavy correlation we've seen with Bitcoin and just, traditional risk on assets, especially just tech stocks. And I mean, when you just look at something like a correlation coefficient between BTC and the NASDAQ, we reached like an all-time high correlation. I think it was 2 or 3 weeks ago. It's sustained at really high levels. So like, do you think as Bitcoin, as you just mentioned, becomes more correlated with broader macro as it gets larger, do you think it just trades more in tune with what's going on in macro, and that correlation with traditional just increases? Or do you think there is a case for potentially decorrelating from traditional assets over time?
So years ago, when Bitcoin was a smaller market, the group of people that traded Bitcoin and the group of people that traded every other asset was like two very different groups with minimal overlap. And so over time, as Bitcoin reached greater levels of adoption, both retail investors and institutional investors, that Venn diagram is kind of moving closer together, where the same people own both types of assets. Um, and so naturally, I think correlation increases in that regard, right? And generally, when Bitcoin is a liquidity play and a macro play, it's going to follow that kind of risk on, risk off things. And so with the stock market during rising PMI environments, you generally see the riskier stocks do pretty well. And during the declining PMI environment, that's when things like defensive stocks or gold or bonds generally outperform some of the riskier stocks. Now, you always have exceptions, right? So in this declining PMI environment, instead of bonds doing well, bonds sold off because this was the first stagflationary declining PMI environment in a while. So there's always going to be curveballs. And so, a big question I had was how would Bitcoin hold up this time in a stagflationary environment? Because if you're going to have a decoupling, you would think that a stagflationary environment would be a decent time for it. So, you know, if you start to see margin pressure on companies and you see the Fed forced to come back and provide liquidity, I think that could be an environment where Bitcoin decouples favorably from broad equities because companies are basically forced to pay higher wages. They're forced, they have all sorts of struggles with their supply chain shortages, things like that. While Bitcoin doesn't have margin pressure, doesn't have employees to play, things like that. And so I think it can decouple when you have very specific conditions that are hurting stocks that are not necessarily hurting Bitcoin. So basically, if liquidity is positive but margins are not great, that should be at least a decent shot of a positive decoupling. But we're not there at the moment. Right now, we're still seeing liquidity being pulled out, and so you see a lot of correlations go to one. And so another thing that fed the whole correlation issue is macro because it's been an unusually strong macro environment. So you had the COVID crash, then you had the biggest liquidity bazooka we've ever seen, and so, the correlation of almost everything went up. And then as that liquidity bazooka is withdrawn, you see a lot of things roll over together. And so because we had a bigger than normal macro impulse, we have a bigger than normal amount of correlation. And I think over time that can separate. And things can separate in terms of size as well. And so, for example, you can say, okay, Bitcoin and ARK are correlated, but if you look at a 5-year chart, Bitcoin has killed ARK in terms of total returns. And that's because over time, one is getting structural adoption and the other one less so. And so you can decouple in terms of timing, or you can just decouple in terms of magnitude, where say up days you do a little bit better, down days you do a little bit better, and over time you slowly separate from weaker assets.
No, that makes a lot of sense. It almost, and this isn't like a perfect analogy, but in my brain, it almost reminds me of that visual that Ray Dalio uses for like the long-term debt cycle, short-term debt cycle, where, as you just mentioned, like in the long term, the thing that's really driving Bitcoin in a 5-10 year time horizon is this adoption curve. And then on the shorter term time frame, you have some of these things that are driving the shorter term price action overlaid with that. No, I think that's super interesting. I honestly haven't thought of it that way before. So that's a really interesting framework. Kind of tying into that, what do you think about inflation? We had the CPI print earlier this week, came in, I believe, at 8.1%, a little higher than some people expected. Some people were expecting we'd see for the first time, a substantially lower CPI print. How do you kind of think through inflation, especially heading into the end of the year? Because I think is especially like these forward-looking inflation indicators, I think are kind of at the forefront of everyone's expectations for what's going to happen with Fed policy. So how do you kind of think through inflation moving forward towards the end of the year?
So monthly inflation's been high for over a year now. And when that happens, you start to kind of peak out in terms of year over year because you no longer have that. Basically, all the base effects wore off. And so, let's say you have 0.5% inflation every month, over a 12-month period, like when that starts to play out, you're going to be much higher year over year inflation than prior because your baseline is like 0.1 and 0.2% year over year inflation. And once you've had a full year of 0.5% month over month inflation, if you keep having that monthly inflation, your year over year inflation actually peaks out. It doesn't mean it goes down, it just means it kind of peaks out. And so you would need to see monthly inflation accelerate in order for year over year inflation to keep going up. Um, and so what we're seeing now is that the supply side is still very problematic. Energy companies are not really producing more energy. Uh, China lockdowns are rippling through the whole global supply chain. Semiconductors is still a problem. The eastern seaboard of the United States is nearly out of diesel, which is catastrophic. Um, fertilizer is still a problem. Basically, there are still structural supply side problems, and I think these are going to persist for a very long time. Um, Now, what we're seeing on the other hand is that demand is weakening because stimulus is being withdrawn, right? So when you're putting a lot of money and giving it to people, you could have that more inflationary impulse, and as you pull that away, then you're more likely to get economic contraction because people are forced to pay more for their food and energy, and they have to pay less. They have to tighten their belts everywhere else, right? So it's harder for other things to raise prices, and you start to get decreased economic activity and shortages. And so one thing that I think could make inflation come in not as high as people think is that it can manifest in shortages, right? So shortages are basically a type of inflation that doesn't show up in the numbers. If I want to buy something and let's say I'm willing, let's say, they're out of paper towels and I want to buy some paper towels and I'm like, I will literally pay 50% above asking price if someone has paper towels to sell and I just can't find them, right? That would have been if I could find them, that would have been a high inflation print, but because I can't get them at all, it just shows up as a shortage. It just shows up as decreased volumes. So I tried to buy a car several months back and they didn't have any of the models I wanted and I just didn't buy a car. And if they would have said, "Hey, we have the car, it's 20% above asking," I would have been, "Yeah, okay. I'm gonna have it for a decade anyway, so it doesn't matter." Whereas because I couldn't even make that purchase, it doesn't show up as inflation, it just shows up as decreased economic activity. And so I think the combination of shortages and inflation are going to continue to various ways, but we're seeing that shift over time because it's no longer that high demand impulse. It's supply side scarcity and declining demand. And I think that's eventually going to do some sort of forcing function on either the Fed to reverse course, or we could start to see more targeted fiscal stimulus. You see in Europe, for example, some of them are doing energy subsidies. And I think we could see something like that in the United States. We start to see political pressure to address some of these situations, and so that could be that could increase liquidity in markets, but it's basically a very challenging decade going forward, I think, in terms of inflation.
Do you think that the stock market declining has had an effect on decreasing demand? I mean, in theory, this makes sense, right? Because you have like this reverse wealth effect. But then at the same time, it's like, well, stocks are mostly held by the top 1-5% in the country. So how do you kind of think through the effects as well as on asset prices declining and how that kind of translates to a potential like decrease in demand as well on the consumer side?
Yeah, there's really different variables for different wealth deciles. As you point out, people on the bottom don't own the stocks. People in the stocks have very different things that affect them than people on the bottom. And so if you're in like the bottom 90%, things like food and energy costs affect you greatly. It makes you have to spend less elsewhere to make your monthly budget work. If you're wealthy, if you're in the top, even just 10%, let's call it, that reverse wealth effect is really real, right? I mean, basically, their whole sentiment has changed around what they're gonna spend, and they represent the majority of spending. The top 10% of people represent the majority of spending, especially on discretionary goods, and so a lot of that I think is going to be weaker. And so you have different variables for different markets. We also see that because mortgage rates have gone up a lot, the cost of buying a new home is a lot higher, right? So, if you have the same priced home and you have a 5.5% mortgage rate compared to a 2.5% mortgage rate, your monthly payments are a lot higher. And that also means that fewer people want to move because if they move and sell their home, they've already got a low mortgage rate locked in. When they buy a new home, they're going to be paying a higher mortgage rate. And so they either need to buy a smaller house to get the same monthly payment, or they're going to buy the same size house and get a bigger monthly payment. So you start to see kind of reduced mortgage activity and financing and movings when you see a rapid increase in rates. And the housing market is a pretty big driver of economic growth. And so I think across the board, whether it's wealth effect from stocks and bonds going down, whether it's energy and food prices going up, or whether it's housing costs going up. I think basically across the board for different reasons, you'll see weaker, discretionary spending, and we're already starting to see that show up in the data.
How do you think through like the political incentives on the Fed? I mean, obviously inflation's been a huge issue. It's been like the number one issue for Americans, and heading into midterms, I think that it's playing a role in maybe why the Fed has been so aggressive. But at the same time, it seems like if they continue raising rates so aggressively, they're going to send us into a recession, which is even worse. Well, in my opinion, I guess you could make an argue for inflation being worse, but how do you kind of think through those political incentives, especially as we head into midterms at the end of the year, and kind of this barbell? On the one end, you have the potential for inflation running away, and then on the other hand, you have the potential for a deep recession if they don't kind of walk this tightrope correctly.
I think people are still kidding themselves that there's like an easy way out of this. It's like, all this inflation's bad. If only they raise rates, we can get back to normal. And whereas like no, as you point out, you pretty much you kind of swing back between inflation and recession. That's the problem when you have supply side limitations. So if there's just not enough oil, for example, your choice is either high inflation or reduced demand for oil through decreased economic activity, which people hate. And usually a recession is more acutely painful for people than inflation, but it depends on what your specific situation is in life, right? If you're retired, living on fixed income, you'd probably rather have a recession than have inflation because you're more impacted by inflation than a recession. Whereas if you're trying to get a job, maybe the recession is worse than inflation, right? So different constituents might have different views, and because most people are not very focused on economic details. All they look at is prices are higher at the pump. My wages, despite the fact that they went up less than inflation, right? So I can buy less gasoline, I can buy less food with my wages, and so when you have that kind of stagflationary environment, it's really bad for political incumbents, and so I think that is going to affect the midterm, and I don't think they have a good choice. They can either, let inflation run hot, or they can try to decrease demand, and either way, it's bad for reelection. And there's a measure called the Misery Index, and it measures unemployment and inflation. And so it's kind of like if you use that framework, no matter what you do, the misery index is going to be high. If you have low unemployment but high inflation, that's bad. If you have moderate inflation, moderate unemployment, that's bad. If you have low inflation but high unemployment, that's bad. And really, the only way to have low unemployment and low inflation is to have a lot of supply abundance, right? So you need to clear out malinvestment, have better investment in supply side things, and that's not really happening right now.
Yeah, for sure. And like, what do you think about the kind of end game for the Fed, like, do you think kind of all roads, and this is like one thing that Preston's been saying, like kind of all roads lead to yield curve control in the end? And like, how do you kind of think through the array of potential outcomes for kind of the end game for the Fed?
I think all roads lead to eventually having to turn dovish despite high inflation. And that could take the form of yield curve control. That could take the form of, just not hiking rates when they were, as much as they were thinking they were going to. Kind of like how in late 2018, they were forced to pivot. And I think they're going to eventually be forced to pivot again, with the difference being that inflation will still be notable, either in terms of the official CPI or in terms of, official inflation plus shortages. And so I think the end game is basically having to provide liquidity into a still high inflationary environment. And that's kind of a balance of payments problems. That's a highly stagflationary type of scenario. And I think that's kind of the quote unquote end game for this particular long-term debt cycle.
Do you think that would be where you'd really just see a massive markup in BTC theoretically, given, everyone kind of saw the playbook from March 2020 and what kind of rallied first off the lows and what rallied, the most aggressive throughout the year? Do you think, if you did see some type of dovish pivot, that would be kind of the green light for people to just pile into BTC?
You would think so. Markets have a tendency to surprise, but logically, yes. If you were to see the Fed kind of capitulate in terms of the ability to tighten, while inflation, while currency is still being diluted, I think you can see things like, you know, Bitcoin, gold, silver, all these different kind of like quote unquote hard monies would have their moment in the sun. And where you can see that decouple, so a number of equities would also do pretty well in that environment. Ones that are maybe doing fine in terms of fundamentals, but their valuations are pressured. I think those would also have a similar jump up. The ones that would still struggle are ones whose business operations are directly impaired by the stagflation. So either they have Chinese supply chains, or they're having trouble raising prices as fast as they have to raise wages to attract the right type of workers. And so that's where you can see decoupling, not just say Bitcoin versus stocks, but the specific things. So specific types of assets and specific types of stocks versus other stocks that are more pressured. So I do think that that would be, you know, essentially a risk on condition, at least for segments of the market. Basically, right now, when you're tightening rates, and you're tightening rates into a slowdown, right? So if they were tightening rates when we had an economic boom, that's not necessarily bad for asset prices. But when you have PMI rolling over and they're still trying to tighten into that because of their mandate, that's when you basically have the dollar go up and everything else go down, or just about everything else go down. And maybe some things like healthcare stocks go down less than other assets, but most things that are not super defensive struggle when the Fed is trying to tighten policy into economic weakness. And so when you do have that pivot, I think you can see the dollar cool off, and you can see a bounce in a number of things that are not directly impacted by supply chain problems and chain problems and wage growth and things like that.
Makes a lot of sense. Lyn, the last thing I wanted to ask you before we wrap up is kind of a non-market specific question, more of a personal question, I guess you could say. It's just the fact of, you have such a wide, not only, breadth of understanding of topics, but depth in each of those individual topics that you have a breadth of understanding on. How do you kind of like manage your time to conduct all your research, and like how do you manage, I guess, your work drive? Obviously, you're doing what you enjoy, but how do you manage that with kind of life quality and able to sustain this deep level of research across such a wide variety of topics throughout markets every day?
Yeah, the number one thing, as you alluded to, is passion, to like what you're doing, so it never feels like work. You're just super interested to see what's going to happen next. And so I think that's the number one thing. As for work-life balance, that has been my struggle for the past few years, just because we've had this unprecedented macro environment. So first it was figuring out what's going to happen with the economy and the pandemic. Then it was spooling up on Bitcoin technical details and things like that while dealing with a challenging macro environment. And so it's kind of like drinking from the fire hose of all these different things. And so, I have not had the best work-life balance. I think a lot of people probably have not in this particular environment. But I think at the end of the day, it's kind of focusing on priorities. And for me, the hardest part is not finding time to write articles and stuff. It's dealing with emails. It's dealing with when you reach kind of a high level of publicity. managing that can be challenging, even though it's obviously rewarding because you're happy that you're touching multiple people's lives. But everybody has a natural bandwidth problem. You can only have so much bandwidth, and so that admittedly has been a challenge in the past couple years.
For sure. Lyn, thank you so much for your time. I've learned a lot today, and I'm sure our audience will get an extreme amount of value out of this. Is there any kind of last words you want to leave our Bitcoin holders with as we kind of head into this unprecedented macro environment and some sour price action from BTC?
So I think the key thing is to make sure that your asset mix matches what your financial goals and your psychology is, right? So, I've for a while recommended some degree of diversification, and that means I'm still overweight things that I'm structurally bullish on, like Bitcoin. But basically, when you have some, say, cash on the sidelines, you have other investments. I have, dividend paying stocks, real estate, things like that. It makes these types of environments a lot less mentally stressful, and it means you can basically take the opportunity to buy some cheap sats, right? So now that can pay off if someone's like 100% Bitcoin. Obviously, the diversified approach would underperform that in the long run. But in terms of your ability to ride that very volatile horse is increased. So you can stay on when you have your risk and volatility budget that makes sense for you. And so I would just say, make sure you know what you own, make sure you have it in the allocation that makes sense to you, and then focus on the fundamentals. Focus on, whatever asset you're looking at. This is Bitcoin and crypto channel. So it's like, if I was talking about stocks, I would say make sure you understand what's happening with operations, right? If we're talking about Bitcoin, it's make sure you understand the fundamentals. Why is Bitcoin different from other tokens? Why, what is going on structurally with Bitcoin? What are the technical details in terms of potential soft forks or client updates, things like that. Make sure you understand the fundamental details, because the more you understand the underlying, the more you can withstand different levels of price volatility.
It's an amazing place to wrap it up. Lyn, thanks so much for the time. I know you're in high demand, but maybe we could get you on in the back half of the year or something like that. But yeah, really appreciate you coming on. Hope you have a great day.
Thanks, you too.